Three, two, one. We are live. Oh, look at that. Robert popped in right at the exact moment. Oh, Robert, there's a little bit of feedback, like visual feedback on yours. So no worries at all. I'll drop you back in here in like 2 seconds.
Yeah, sometimes it goes away. I really have no idea what causes it.
No
It's
worries. So let me drop you down, and I'll be keeping
it's
tabs on the bottom here.
Okay.
All right. Okay, cool. Guys, welcome back to Wolf. We'll have Robert back here on in 2 seconds. Talking all things markets, talking all things housing, real estate, Bitcoin, all the things. We have Joseph with us today. We have Robert Infra with us today. And I'm very excited sort of to get their thoughts on how the markets are going, how these are affected, how the markets play together. Probably the biggest trend has been seeing like the commodities have run, and then all the Bitcoiners have like found ways to figure out how that how the two conversations come together, how they affect each other and stuff. The stock market, like people didn't expect Bitcoin to maybe trade the way it has this year. They thought maybe you'd trend more like gold, and then it didn't. And so there's all sorts of markets. Me and Robert have done like a bajillion streams and spaces together where we talk about all these things. I'm fascinated by the way his brain works as well. And so we have all three of us together talking all the things. We have Joseph coming over from Milo, which is Bitcoin Mortgages. And I'm going to drop a link down below the stream if you guys want to check that out. And a little bit more on that in a bit. But Joseph, how are you, man? It's good to have you.
Yeah, it's great to be here. It's awesome. I get to see Robert in person, sort of.
Finally, right? This is the first stream together.
To hear.
Yeah.
Right on. Well, it's too bad we couldn't do it like 2 seconds. I literally clicked live, and then Robert popped in. I was like, oh, I needed like a 2 second undo. But no. Well, I guess Robert, this is Joseph. Joseph, this is Robert, live on the stream.
Good to meet you.
Yeah, likewise.
Yeah, man, 100%. Robert, how are you, man?
Good. Yeah, there's kind of a lot going on.
Yeah.
A lot going on. Yeah, I mean, with respect to mortgages, rates are coming in, so that's probably helpful. And we also have the move index moving lower kind of over the past year or so. So that's probably helping mortgage rates too, I would imagine. It's not something I look at every single day, but my guess is if the 30-year is declining and 30-year yield is declining and the move index is declining, that mortgage rates are probably coming down quite nicely.
Yeah, they've come down a lot. I mean, I think that if you think about, a lot of mortgages are tied to, essentially, the 10-year, which has been sort of stubbornly high, right? It's kind of hovering around that 420, right? And so we haven't been able to see that come down, but I think that the aspect of the spreads, right? So basically, like that spread of like treasuries to mortgages, that's what's actually been coming in, and it's pretty much at all-time tights here. And that's an aspect that, as the expectation that rates will be lower, people want to basically pay up for this higher coupon mortgage paper out there, right, in the capital markets, and that's causing there to be a lot more competition, specifically tied to capital markets demand for mortgage rates. Right? So you're seeing that specifically in like the conventional, which is like Fannie, Freddie, where Pulte lives, and then you've got sort of like the non-QM market, which is more like the investor mortgages, the stuff that's a little bit more I would say different types of underwriting, sort of like where we live, and that generally tends to have a little bit higher interest rates, and that's actually starting to get pulled down, and there's just not enough yield out there, right? There's not enough origination where historically mortgage originations are around 3 trillion, right? Like we're here at like 1.7, 1.8.
Wow.
Things to be like where we were, right, in the refi boom, which was like north of like 4. So people want things to pick up, but we probably won't get a meaningful refi boom until rates probably come inside of a 5, which is why you see the push for the agency to go out and basically buy 200 billion in mortgages, see if we can basically bring in that long end of the curve down. But again, it's more of like a policy decision, right? Like if we actually think that there's going to be inflation in the medium to long run, then it'll be hard to bring it down, even if the short term yield curve basically comes down, right? Which we know that's imminent here.
Yeah, that's kind of what I expect, honestly, is that we're going to get a steepening of the yield curve, but probably more of kind of this twist steepener where the short end is coming in, but long end probably doesn't do much. But if the move index, if they're able, and Rick Reeder talked about this before the Fed chair announcement, he was doing an interview with Bloomberg where he mentioned, look, all you got to do is bring bond market volatility lower and you'll get that spread that you referred to compress and effectively get lower mortgage rates while the 10-year might not have moved at all. Now, they didn't pick Rick Reeder, but I would assume that there's probably like some degree of awareness of that aspect of it.
Yeah. Hey, Robert, how do you think that decision played out? Because I think a lot of people, including me, right, we were thinking that like Rick was going to be the guy, and then like didn't happen, right? Kind of like
Yeah.
a market, right?
Yeah, I think the market was priced more for a kind of Kevin Hassett rather than a Kevin Warsh. And so, you saw kind of Dixie rally after and gold sell off and silver quite hard. So I think the market was priced much more for like Kevin Hassett, who would have been. I think the calculus, politics is not my strong suit, but if I had to guess, the kind of calculus was we need someone who can cut rates, but not appear to be doing it for political reasons.
Yeah,
And I think Kevin Warsh had that kind of legitimacy behind him that someone like Kevin Hassett probably wouldn't have had.
yeah.
That's
Kind of
kind
said
of
what you need to do to get the job, and then say, here, I'm probably going to be here longer than this administration. So if I need to pivot later on, then I'm still here.
Yeah, and I think it was Bloomberg that I saw a chart earlier where they tracked his hawkishness and his dovishness over different parties in power, I guess. And he's generally pretty hawkish under Democrat administration, and generally pretty dovish under Republican administration. I think we're going to hear a lot more of the kind of productivity boom, allowing for lower rates without corresponding inflation. I think that's something that I'm noticing kind of appear more and more. That the sky high productivity that we're kind of starting to see is going to allow for lower rates without causing inflation, because I think that part of it is pretty difficult right now for the administration, because inflation is so sticky, and people were so damaged by the kind of past 5 years of inflation that it's really like a hot button. Like the average American is just primed and ready to go off at the sight of higher inflation. So I think it's going to be a tightrope for them to walk, especially when you have the labor markets like softening pretty dramatically with the latest JOLTS report. You could have a situation where GDP is high and productivity is coming in great and the stock market's ripping, but unemployment's probably grinding higher, and it's a very interesting kind of landscape that they have ahead of them.
Yeah, I mean, definitely that it felt like the market wanted a certain candidate, and then like it was like everyone's just offsides, and then it was like scrambling, and then all of a sudden like everything started to like cascade from there. It's kind of like, oh wow, like this is not what we were expecting. Let's try to like figure it out. And like first reaction when like something's really unknown in the market, it's like we got to sell.
Yeah,
and then we can buy back in when we know where the world is. Except that like really sensitive levels where basically like everybody was like expecting something, and then now like this massive like recalibration of it. And I think that everybody's like, oh well, like gold and silver and things like that, right? Safe haven trade. Except a lot of people forget that like cash is also a position in the market, right? Like you can go and say here, like I'm going to rally or rotate into like for my equities into gold and silver, but then it's like no, like cash is probably the best position to be when there's like all this uncertainty. And everybody's been sort of like so negative on the dollar, where now it's kind of like, okay, dollar's not a position. It's like no, like dollar is probably where most people want to be overweight today, given some of the overhang and things that are out there with a lot of these uncertainties.
Yeah, and it was interesting kind of the timing of it. Like if you look at the Dixie, it was about to break down out of that uptrend that has been going back to 2008. It was literally like starting to break down below that support line for the kind of all the TA folks. I was starting to break down, and then you get the Kevin Warsh. Everyone is positioned, like you said, super bearish on Dixie. And I saw some charts floating around that showed the actual positioning, and it was like record bearishness on the dollar. And then you get an announcement of arguably one of the most hawkish out of all the potential candidates. It's just kind of that like poetic justice that you kind of start to notice in the markets, over time. It's generally not what the market is positioned for is what ends up happening. I would argue Kevin Warsh is probably not going to be that hawkish. I mean, people are bringing up the comments that he made about bringing the balance sheet down to 3 trillion. It's like there's no way he's bringing the balance sheet down to 3 trillion because you would have to find a liability, Fed liability. Reverse repo's empty. You can't really bring down the TGA because we have so many T-bill redemptions, about 600 billion every 5 days. Bank reserves, can't bring those down because we saw what happened to the repo market, which is where the basis trade is financed, and that basis trade being 40% of the demand for new U.S. Treasuries. So they can't let the repo market go, which means that they can't let bank reserves decline too much more. hanging out right now around 2.9 trillion. So yeah, I think that, you know, people are a little, I think that the market kind of overreacted. I don't think he's going to be nearly as hawkish with the balance sheet. And I also don't think he's going to be all that hawkish with interest rates. I think he's going to cut interest rates probably more over the next 2 years than the market's pricing in.
Yeah. What I mean, I haven't seen a lot about sort of like his commentary, but like, what's his stance towards like stable coins and things that happen? Because I've been watching that, like, and normally with like all this like positive momentum around stable coins, like you would have expected the growth of basically stable coins, and it's actually been relatively flat to slightly down, sort of in the end of last year. So you've got new players coming into the market, but you don't necessarily have new issuance of stable coins, right? Where like dollars are being dropped into the system.
Yeah, that I'm not sure about. I know he made some comments regarding Bitcoin that were, in my opinion, pretty positive. He called it something like he didn't say the last functioning smoke detector, but it was something along those lines. A check on politicians, a check on the central bank, something like that. So, you know, I would imagine he's probably more. He appears younger. I don't know his age, but he looks younger. And he's made some positive comments about Bitcoin. I would imagine he's probably more open-minded because I do think that that stable coins are going to be part of their strategy. They need balance sheet to repress. Well, you know, who's gonna willingly sign up to be the balance sheet to be repressed? You know, I think it'll be T-bills, it'll be stable coins, and T-bills will be giving, you know, negative 200 basis points of real yield.
Yeah. So we've been talking about like, you know, the yen and the carry trade and all of that. I mean, obviously there's been a lot of big momentum there. Like, what's your sort of current thinking and positioning, and like when does this start to like really become a problem, right, on a macro level, given like where their rates are?
Yeah, I think when it comes to the carry trade, I think that the issue was that Japan was kind of this liquidity engine where by running negative real rates and negative nominal rates, they were basically, I mean, there was basically free money being printed. It was in yen terms, and of course those yen had to get converted to dollars because no one wanted to be in the yen. So you had all this kind of creation of all this new liquidity that flowed into various yield-bearing assets, like you said. You know, we're talking about mortgage backs, but also U.S. Treasuries.
For people, like how long the yen carry trade has been happening, because I know like it's way before like even like long-term capital, right? So like maybe give some of the viewers like an idea of like how long this trade's been playing, because a lot of people hear about for the first time, they're like, what's this yen carry trade? This must be a new thing. And I realize like this is like a long time in the markets.
Yeah, I didn't know it was before long-term capital management. Then it's been going on really a long time. I was kind of referring more to the past 5-10 years. But yeah, and so like you had,
so I mean, this, like I was doing like the version of like the carry trade with like borrowing in yen for clients at Goldman Sachs in 2006. So, you know, that's a decent amount of time, right? That's like 20 years from like when I was utilizing it. So like, and this was like long-term capital where like a lot of the like financing function for that, right? Basically piling on leverage was basically because you were financing at very low levels. So it's got of 30 years where like this new trade, right, has been on the table, right? Now it's just unraveling, which again, a lot of people have put on positions over that period of time where they expected it to implode and have gone broke trying to bet against it. And then now it's like, okay, now it's actually unwinding, right? And
yeah, and in July 2024, it might have been August, whenever that kind of yen carry trade unwind in 2024, I read an article that 7 trillion was currency unhedged. So they were putting this yen carry trade on, and then they weren't even hedging for the currency risk, which is kind of wild. And that's what caused kind of the chaos and the volatility in U.S. equity markets was that so much of it was unhedged. And you have a situation now, like when it comes to the dollar yen,
you don't need to hedge it, right? Like you don't need to hedge something that is relatively stable, right? You only hedge if you think there's implied volatility, right? So
yeah,
there's no point in that like very cheap hedge.
Well, and the yen was basically always weakening. So in their eyes, it was, and I think it applies in the other direction too with the dollar. There's a lot of dollar longs that might not have been hedged because the dollar always strengthens. The U.S. equity market always goes up. Bonds are in a secular bull market, so the U.S. Treasury is gaining in value. There, I think in the other direction too, there was a lot of complacency that developed, not just with yen carry trade, but also vis-a-vis the dollar. But with respect to the yen carry trade, just as kind of like a trader, I noticed that, with this sweep of the lower house election that just happened, 36 hours ago or so, you had kind of a bit of a news failure on dollar yen. So we actually have seen the dollar weaken relative to the yen, or the yen strengthen relative to the dollar, in a situation where the Populist Party is, winning this huge landslide. We saw the reaction in dollar yen and the bond market, especially when Takaichi won the prime minister. And so you would kind of expect a dramatic weakening of the yen with this lower house landslide, really. And we didn't get that. In fact, we are seeing strengthening of the yen, or weakening of dollar yen. So a bit of a kind of news failure. And if you look at the dollar yen chart, like zoomed way far out, I could make a convincing argument that the yen is going to strengthen for the next 2 or 3 years. I know some traders that are starting to kind of start to nibble around a position for just that, because we need a weaker dollar. Scott Bessent, with his background being what it is, I was kind of talking, one of the first people talking about Mar-a-Lago Accord before it even had that name. And I've always kind of subscribed to the view that they need a weaker dollar. And whether that comes via like a Plaza Accord 2.0, where everyone gets together, it's an official meeting of kind of G7 or whatever it may be, or whether it's kind of individual agreements that are made in kind of backroom deals individually. We, going back maybe 6-9 months, there were a number of articles that were coming out of Bloomberg regarding Scott Bessent and conversations about the won, which is the South Korean currency. And so, there's kind of indications, in my view, that Scott, rather than kind of one singular, Plaza Accord 2.0, everyone is meeting at Mar-a-Lago or something, rather than that, you could have a situation where, there's a deal made with the Japanese, there's a deal made with the South Koreans, there's a deal made with the Taiwanese, right? And we just go around and kind of make these individual arrangements because, if they're serious about reindustrialization, we need a weaker dollar. The dollar is grossly overvalued, and that is going to severely hamper any effort to truly reindustrialize. And I think with what we're talking about with financial oppression and the T-bill issuance, I think it helps achieve that goal. Part of it, you're running negative real rates at the front end, and that's probably dollar negative. So we could, maybe a year or two down the road, if they are really serious about weakening the dollar, it's going to start causing issues elsewhere, right? The Europeans are going to start to get a little upset. ECB officials have noted 120 on, is kind of their line. So yeah, I think the next couple of years could be very interesting for currency traders.
Yeah, I mean that's interesting thinking about sort of like how much of U.S. treasuries, right, that are held by all these sovereign nations around the world, right? They're dollar denominated, right? So here you have a situation where you're clipping, 200 basis points, 300 basis points, but meanwhile you're devaluing, 10%. Right. So on a real nominal perspective, right, like you're actually losing money by holding U.S. assets. So that's generally not a good position to be in, especially with the amplification where most people are holding a little bit longer tenure than basically 30-day paper. They're holding a few-year paper, right? That's probably getting crushed, right, on a mark-to-market basis for a lot of these sovereign governments around.
Yeah, and it's starting to already cause issues. Like even 9 months ago, the Swiss took their rates negative to try to disincentivize some of the flows into the franc. It's not working. So I think that when it comes to we might be entering that kind of beggar thy neighbor sort of situation landscape, I guess, over the next couple years. And again, I keep coming back to when I was thinking about this stuff deeply in 2024, 2025, I kept kind of playing it out, and the end conclusion is always that you have to have some kind of arrangement, some kind of agreement amongst nations, because otherwise, it's kind of a race to the bottom. And like, I just don't see how it resolves without kind of Mar-a-Lago Accord or whatever it may be called.
I mean, if you're a sovereign nation, you're holding a bunch of treasuries, and like you know that it's going to continue to devalue, and like everything is telling you that the dollar is going to weaken. Like your rational decision would be, I'm just going to dump these securities and move on to something else and locally denominated currency and strengthen my own bond market, right? And so it was very interesting that I think it was about a week ago where it basically said there's going to be repercussions for governments selling treasuries, right? So the fact that they felt the need to go out there and say that publicly was pretty interesting, when naturally like you're telling someone else saying like, you have to keep holding my paper and you have to be okay with taking a loss in it.
Yeah.
Where for such a long period of time, right? Like, sure, I'll clip the 3%, but I'm going to get, a 5%, 10% FX gain. And that's actually worked out pretty well for most governments around, right? Being in the strengthening dollar. So here we are basically doing the opposite. So it almost becomes like a very easy trade, right? For nations to just say, look, we're gonna get rid of this. So you're right. Like if we don't have these accords, we're basically just understanding that like, you help me and I help you. It's going to get pretty lonely on the treasury side. And that's why I'm referencing like the stablecoin aspect, because, we were highlighting how like that would be such a new demand for these treasuries, right? Like the new issuance, right? But trying to stay relatively on the short term, right? T-bills, new issuance, new stablecoin issuance, that was going to basically offset some of this like, treasury takeout. But, here we might be like in a situation where we have like more sellers, and it's just really hard to figure out like where you want to stand on the curve, right? Of issuance.
Yeah, I mean, there's like huge demand. Some of these the T-bill auctions are just like enormous, like $100 billion auctions, and the bid to cover is 3.5. Like there's clearly I think that they've realized this going all the way back to Janet Yellen, that there is demand, but the demand is not in 10, 20, 30-year paper. It's in the short end. So I think that I think that when it comes to the dollar and to the currency issue, I think that when you have a situation where the dollar has just always appreciated, we run these huge current account deficit. The agreement was, we'll ship you dollars, we'll export dollars to you via the current account deficit, and then you will reinvest those dollars into dollar-denominated assets, whether it be U.S. Treasuries, equities, whatever it may be. The dollar gains, so you get that FX gain, but then also the U.S. equity market does well, best in the world. U.S. Treasuries had been in a kind of secular bull market, and we're kind of entering a world where that's no longer necessarily true. And if that flywheel starts to go in reverse, it was a virtuous cycle when it was going in the other, the right direction. But if it starts to go in reverse, I mean, we're talking 65 trillion on a gross basis that foreigners own of U.S. dollar denominated assets. 65 trillion is a lot. And on a net basis, our NIP is like negative 90, 95% of GDP. I've often made the argument that illustrates that the U.S. has lost sovereignty, because, what happens when we start to do, Triffin's dilemma ultimately is that as the reserve currency issuer, you will get to a point where you cannot adequately serve your international and your domestic obligations. And I would argue we've gotten there, and we're choosing clearly our domestic needs over the international needs, but all the international, the rest of the world, they start dumping U.S. treasuries, and we have seen what it does to the administration. So if we start doing things that the rest of the world doesn't like, they'll just dump U.S. dollar denominated assets. They own a lot of it, 65 trillion, about 26 trillion on a net basis. I would argue that they're really in the driver's seat. We might like to think, especially with some, I'm sure in the administration, they especially like to think that they are these big, strong men and they're independent and they can do, shake everything up and do what they want. But the foreigners start selling some of that 65 trillion gross, especially the bonds that they own. And, it brings Trump to heel faster than anything I've ever seen. I mean,
it feels like we hold our hand on that side, right? Like basically saying like it was very easy for us to just assume that people needed to buy our treasuries, right? Like that pact that we have in the world, right? Like, we buy your stuff, you take our dollars, and you buy our bonds. But naturally, like, because our bonds were safe and they were making money. But I don't think the trade works as well when you tell them, here, buy our bonds and lose money.
And we're
right?
going to financially repress you. Yeah.
Correct. And we're going to do
Yeah.
all things that like are not going to be in your interest. So clearly, like we're no longer friends, and you could even almost go to the point like we're now adversarial, right? From that perspective. So they may not dump immediately, but they may not buy anymore, right?
Yeah.
So like that's like, where do I reallocate? Well, I find it fascinating that like German bonds trade tighter than ours, right? Aren't we supposed to be the risk-free rate in the world? Yet Europe trades inside of where we do, right? But supposedly Europe's not doing that great. So it's a very interesting comparison, right? To say like maybe we're not in that strong of a position as we thought we were, and now kind of almost like historically like we've bluffed with what we were going to do with capital markets. Now here we're like incredibly transparent, right? Like people didn't really know like whether the dollar was going to strengthen or weaken or like what was going to happen. Like it would happen because it was just happening. I can't remember, right, in my adult, professional financial life, kind of saying like, no, we are telling you what we're going to do. Like it's such an obvious momentum, like what's going to happen. And when you no longer bluff, you just say it, then now people are going to react to it, and they're going to position accordingly for it. So
and additionally, Stephen Myron put out a whole paper on how to go about kind of doing this, right? Back in, I think it was October, November 2024. He put out the entire paper, User's Guide to Restructuring Global Trade, I think is the title. And he talks about all this stuff in the paper. And then Trump nominates him to, the Council of Economic Advisors. It was kind of all out there, like for those that were willing to see the signs. I think it was extremely well telegraphed, because not only is it kind of being tacitly communicated by the administration, but you literally had like the chairman of the Council of Economic Advisors write a paper talking about how to weaken the dollar. And he mentioned even in there basically taxing foreigners holding US dollar denominated assets. I mean, talk about like a change in regime from what you were just describing for the past 50 years or whatever. That is a notable change if we're going to start even considering taxing foreigners. And I don't have the exact details, you might know, but one of the propositions in that paper was to tax the interest on foreign held U.S. treasuries back at a rate that apparently
usually withholding like 30%. 30% has been sort of like that withholding, basically like by foreign entities owning U.S. assets, right? And with distributions of income. So it's 30% is that number that's been historical.
But they got rid of it, I think. Because Stephen, in the paper, Myron talked about re-implementing it. So my assumption was that it had gone.
It depends on the types of bonds too, right? So basically, so like depending on like the regs, right, or like 144s, right? It depends. There's definitely some like regulation of sort of like how those bonds are structured and where they're domiciled, right? So like corporates and emerging market bonds, right? Like how they're set up. So there still is some like taxable considerations. It might just be different around just sort of treasuries, right? And tenure that has an impact. But historically, like that's why you set up like SPVs and different entities and feeder funds to be able to get around some of that like blanket like tax.
And that's Cayman, right? Like Cayman is the king of feeder funds, right?
Yeah, Cayman, Ireland, Luxembourg, right? Like you've seen different structures to be able to do that, but a lot of it just is a function of like who the buyer is, right, and the concentration of like what they're buying.
Yeah, and what's crazy to me, Mike Green did a interview years ago, it seems, where they were talking about the fact that the U.S., because of the arrangement, was we will maintain kind of the freest, most liquid, most free, meaning least amount of questions in terms of our capital and financial markets, and reinvest the dollars. We don't even know. Like, these huge current account deficits that we have been running, the other side of that is that foreigners have been a creditor to a huge degree. I mean, 65 trillion gross, 27 trillion net. We don't even really know exactly where that money is due to the fact that we were trying to be the reserve currency that doesn't ask questions. Bring your dollars here. Not only does our currency appreciate in FX terms, but we have we don't ask any questions. It raises some interesting questions about, okay, well, we've run these huge bilateral deficits with China. How much equity in maybe Northrop Grumman and Lockheed Martin does China even own? even that question, I mean, it's an interesting question, but no one knows. And that was the arrangement, and that arrangement is, I think, clearly coming to an end. And that doesn't necessarily mean the dollar is like gonna die and go to zero, and Dixie's good. None of those things. You can have a situation. I think that this plays out much more around the margin over the next couple of years, maybe even decade or two, rather than kind of a sudden thing that a lot of people might expect or want.
Yeah. Do you have you seen anything in terms of sort of just like flows where, like, we're talking about like the yen, like like into Swiss franc, or any other sort of like markets or like pockets of capital where you've seen kind of like a growth in either issuance or demand or interest that we can start to see, like where are things moving towards, like what's that change? Because clearly it's very obvious that there is going to be the change, and I think the question is like, what market is the net beneficiary of that change?
Well, I think a weaker dollar is beneficial for emerging markets. So you've seen some amount of kind of outperformance with certain emerging markets. European equities have done pretty well and outperformed there. If you look at like the S&P 500, sure, in dollar terms, it's up. For 2025 was up like 18%, but in euro terms, it was up like 0.5%. It was basically flat. So there clearly has to be kind of a new a new area. I would also kind of bring up that this morning, I think it was this morning, Google had like a huge offering of the Century bonds, and they was like grossly oversubscribed over in Europe. I think it was Swiss franc denominated or pound
By the way, Robert, you
denominated.
can bring up, if you want to pull up any charts or have anything on the screen, we definitely can for the stream.
Yeah, I couldn't I couldn't find any Google bonds in TradingView, but yeah, I thought that was interesting that despite kind of the narrative of all this kind of AI concern and that sort of thing, that you had this huge demand. I mean, the demand was immense, and they were Century bonds. So I thought that was kind of interesting. But I think that weaker dollars, commodities are probably going to start to get a bit. I've been bullish on that for a few months, and you're starting to, I think, see kind of the early stage of a breakout in, for example, the S&P Goldman Sachs Commodity Index. Emerging markets will benefit from a weaker dollar. I think that like gold is kind of cliche at this point, but I would expect gold probably continues to do quite well over the next decade. But yeah, when it comes to I don't know if there's going to be like I know that there's a huge amount of necessity for sovereign paper, but I don't know if a country really emerges as the next U.S. I think that it's much less
so much as the next U.S. I mean, I don't think there is a next U.S. right, because there isn't a market large enough to be able to absorb the broader flows, right? I think it's more of like on the margins, like what actually grows. And the reason why I was bringing up Swiss franc, right, is generally because they've got a very, very low borrowing cost of something that's basically rival, where now you're basically saying, okay, well, like if I need to play this financing, right, like carry trade, like where does that start to like pop up, and what starts to compete for some of that positioning? Generally, like you've seen that Swiss francs are like low single digits, and then obviously your biggest concern there is just basically your hedging cost, right, which brings you up, but you're still generally lower on a borrowing cost, and you're going to be basically trying to basically take dollar denominated repo, right?
Yeah, Danny Dion actually posted about that earlier today, which I thought was interesting. Yeah, if you look at like their 2-year yield, it's negative 12 basis points. Yep. So yeah, I'm not sure. But I do think that like commodities, and I think gold continues to, like, I'm still very, very bullish gold. I think Bitcoin eventually, hopefully here, will start to get to benefit from some of those kind of flows that are looking for a neutral asset that's not centralized, that cannot be seized or defaulted on, like we did with the Russian FX reserves. And gold, all the properties of gold, like we know, the properties of Bitcoin, does everything gold does, but better. I still do believe that over the next decade, eventually you're going to see, a recognition, and you're talking about, $1.5–2 trillion asset in Bitcoin. I think that there's a ton of, this is one of the main reasons I'm so bullish on Bitcoin, is I think that, you talk about 100, 200, 300 trillion trying to squeeze into a $2 trillion asset, or gold, even gold, which is, still much larger than Bitcoin, but still relatively small in the overall scheme of things in the context of kind of what we're describing.
Yeah, it's unfortunate that Bitcoin, like the asset class, right, as a sizing, right, the 2 trillion, right, it's not larger, right? Because I feel that like if it was 10 trillion today or 20 trillion, I think you'd see more like rotation into it as a counterbalance to some of the stuff that's happening in the world, where it's just not large enough to be able to get the right amount of exposure and to be able to right size those positions. Because we're not talking about generally flows that are to the extent of like 100 billion. Like we're talking about like massive flows that are like well into the trillions across global markets, which is north of 600 trillion. So you do need sizing, because you don't ever want a situation where you're such a high concentration of a broader market, right? Like if someone said I need to put on a $200 billion position, how could they do that into Bitcoin, right? Today, it's not feasible, right? Where if you said, here, I need to take 200 billion and put it into treasuries, right? It would take you, a couple of days, but, you'd find the dealers to give you the size and you'd be able to put that trade on to make the shift. So we're just, we need Bitcoin to be bigger. So then it does start to become this counterbalance to some of these like macro themes that are out there. And, that's the part where like, for me as a, thinking about Bitcoin in the long run, is that like, it feels like we need that to happen. And the people that understand this are going to try to will it into happening. The question is just in what time horizon will that materialize?
Yeah. And I think, a lot of folks like with the recent drawdown, maybe they were levered, but the sentiment is just so bad in Bitcoin land over the past couple months. I'm not worried at all. Maybe I just have like a super long time horizon, or maybe it's a conviction thing. I'm not sure, but like I've been loving the drawdown because I get to accumulate more, and I'm thinking 10, 20 years out. It could take a while because the early adopters, like normal people, maybe firms like kind of the Michael Saylor strategy and the DATs, you have to have those kind of early flows, and eventually, like hopefully my exit liquidity is going to be the sovereigns a decade or 2 decades out that are trying to address kind of net settlement issues in a neutral scarce asset that goes up. Because to the point of what we were talking about earlier, where these funds were just reinvested in the dollar, and the dollar, the FX gain there. If you're an FX reserve manager, you're like, the way I try to describe it to normal people is the country has like national savings. You're trying to manage the national savings of your entire country,
and those sovereign wealth funds, right? That just sit on all this capital, right? They've got a fiduciary right to their citizens, right?
Yeah. And like, if I was sitting on one of those desks or working at a sovereign wealth fund, I would be pretty worried that like if I made the wrong
clients at Morgan Stanley, right? So we were covering some of these institutions in Latin America, right? So that we were constantly in this situation of saying like, do you buy local paper? Do you buy dollar denominated paper? Right? We were buying a lot of stuff in in Peru, Colombia, Mexico, Brazil on the emerging market side. So like the point that you brought up specifically about like the dollar aspect was, it's actually great for these emerging market countries, probably better than most people realize, because back within the last 10 years, right, so much paper was issued in dollars that it was actually hurting them. But now, right, like their local currency accounts, right, they're able to basically pay back this dollar denominated debt with local currency. So they're going to have very positive 10, 15, 20% swings in their direction, where they were probably looking at this 5 years ago saying like, how are we going to pay back these dollars with our local funny money, right? So
yeah, it's kind of the opposite of the dollar milkshake theory. Like I like Brent, and it's not shade or anything, but like when you have an asset, when you have something that's starting to dollars weakening, when you have number one, that is kind of de-levering all those dollar denominated debts, number one, with the dollar declining, but then you also have it depending on where various capitals is, if it's in gold, not only is the dollar declining, but if you're an emerging market that's saving in gold, you have the price of gold just absolutely go parabolic on you. So you have the dollar denominated debt declining. The burden of that dollar denominated debt is actually going down. It's not going up, which was
Yeah.
kind of the whole thought process with the dollar milkshake, is that the dollar kind of would, rip higher, and then the dollar denominated debts would get larger and it would cause an issue. But yeah, like we're kind of seeing the opposite. And if you were in, one of those emerging markets with dollar denominated debt, all you have to do is look to gold, and gold will de-lever the burden of that dollar denominated debt. So I think that's kind of like an interesting, that would be my question to Brent is like, I totally get where you're coming from, but how do you factor in assets that are starting to appreciate versus the dollar to such a degree? I mean, gold has basically doubled. You have Dixie down, 10, 11, 12%. I think that, certain currencies even more over the past, 12 to 18 months. But if you have assets like gold that are starting to, give the performance and get to the size that they are, where it's de-levering the dollar denominated debts, like how do that would be my question, Tim, is how does that factor in? Like, dollar franc, dollar yen, dollar euro, you're getting a weakening of the dollar there. Then you're also getting if the capital in that foreign country is in gold, well, gold is dramatically outperforming the dollar. So that would be my question for Brent.
Yeah. Yeah. I mean, what do you think in sort of broader sentiments of the market, right? Because it did feel that like towards the back half of last year, given everything that happened, looking at macro and everything else, like it felt like there was a little bit of fatigue in the market. And then like now sort of like positioning with like, things selling off and sort of like resetting. Like, do you feel that like this was enough of a sell-off for people to basically start putting on like net new positions and trying to basically pair exposure net long? Or are we still in this position where it feels like people are still going to like deleverage and that fatigue is still there and saying, okay, we probably let's just pair to cash, let this thing reset, and then sort of like get back into this like sort of end of Q1 beginning Q2, right?
Yeah, I'm not sure. I do think that like if we're not there already, we're probably getting closer rather than farther away from that point. And so yeah, like all these dips on Bitcoin specifically, I'm buying. If you look at like the US equity market, there's been rotation under the surface happening going back to like late October. Pretty violent. Some days the rotation is pretty violent. You don't see it in SPX, just kind of the headline index, but underneath the surface there has already kind of been a pretty dramatic rotation underneath the surface, going back to like late October, where it kind of the one trade that was working, which was Mag 7 and kind of that momentum trade, 23 24 into 25, that is, I do think, starting to or continuing to get unwound. I mean, it started to get unwound late October. That was kind of I think it was October 29th, where that trade started to kind of not work as well. And so I think, it'll take some time to fully digest when it comes to like the US equity market, because like, materials are parabolic, they're vertical, consumer staples, I think, as well. So yeah, there's going to continue to probably be rotation under the surface in the equity market for this kind of, reflation sort of cyclical sort of trade that appears to be being put on. When it comes to Bitcoin, like I don't see how that doesn't benefit. If that is indeed what kind of the market is positioning for, I don't see how that is bad for Bitcoin. Like, especially with a Fed chair that's going to come in and arguably run negative real rates and be pretty dovish. I think the hang up, and maybe for Bitcoin and gold, maybe even for the next couple months, might be we might think, or we might know, that Kevin Warsh is not going to be that hawkish, but the market might have some concern about it. And so I think it could take a couple months. First, he has to get confirmed, but then for the market to really see, Kevin Warsh is not nearly as hawkish as we thought he was going to be. Let's bid Bitcoin and gold, and maybe that starts to work again.
Yeah. Do you see anything else on the horizon that's a catalyst for Bitcoin here? Or are we just going to sort of trend, bump up and maybe retest and then sort of kind of like trend here, consolidate, and then before we get sort of that time horizon where you're saying probably feeling more like a Q2 type movement into Q3?
Yeah, I mean, I don't know. I don't think that there's all that much more downside on Bitcoin. I think that sell-off that we saw over the past kind of 2 or 3 weeks, I think we saw kind of a very capitulatory sort of low. Volume just spiked. You had sentiment basically at like, all-time lows almost. And you had that kind of like parabolic, price action where just waterfalled. So I don't know, maybe we might retest those lows. We might go to 58, but again, I think it comes down to like time horizon. For me, I'm unlevered when it comes to Bitcoin. So I'm looking, super far out, and I'm not really worried. Like if we go to 58K, 59K, 55K, I'll just buy more, because again, I think that over the next decade, Bitcoin is going to perform exceedingly well. And when it comes to this quarter to quarter, month to month, week to week sort of price action, for me, at least personally, I'm not really super worried about it. But I mean, we saw ISM manufacturing just rocket back into expansion territory a couple days ago. And, we've seen some now on the labor market side, like economic data is not looking too great, but with JOLTS and Challenger Green Christmas and initial claims this past week. But, I think that when it comes to like economic growth, which I would argue Bitcoin, obviously liquidity, but I think that I don't see how economic growth doesn't benefit Bitcoin. If we're printing 5% real GDP like they're talking about, I don't see how Bitcoin is going down in that world. I can't see that argument.
What's the level on Bitcoin where you look at it and be like, okay, something's wrong here, like something broke, or something's kind of like changing your thesis or like, medium term positioning?
It's not so much Bitcoin dollar as Bitcoin gold. That particular pair is kind of the one that I would start to have like serious concerns. I don't have like a particular level when it comes to Bitcoin gold, but I would kind of know it. You kind of know it when you see it. But that was kind of Luke Groman's entire. Quantum was part of it, but a large part of the reason that he kind of rotated out of Bitcoin was the degree to which it had underperformed gold. I mean, in gold terms, Bitcoin here at 68, 69 is basically where we were in June of 2021. So we basically kind of gone nowhere in gold terms. And so I think that's probably the thing to watch rather than Bitcoin dollar. But on Bitcoin dollar, like if we went to like 20K and then just stayed there, something like that, it would be okay. Maybe I was wrong. Maybe there's something to look at.
Yeah. My level is around 40, right? So basically saying it's sort of like that retesting of sort of like the previous two pullbacks of basically saying sort of a 75%, pullback sort of like highs. So putting us somewhere in that 40 camp. I mean, we were speaking to a lot of clients last year, and there was downside concern down to like the 60s. So roughly sort of where we were, and some people that have been holding Bitcoin for 13, 14 years, kind of saying, yeah, we could see that. And they were concerned with kind of like the 60K levels, even when Bitcoin was at 100. So that's what they were looking at, and then kind of saying, okay, well, like it feels that like people get really comfortable in sort of like this pattern matching aspect, saying, okay, well, like we don't want it to get there, but like we would see why it would get there, because that's what people are looking at, right? Those levels. So kind of like that 40, which I don't want it to get there, but at the same time, right, like just saying, okay, well, like I felt pretty bad at like 100K Bitcoin that I didn't have enough exposure to it. So now it's kind of like, okay, we're going to get another shot at it. And like history has always said that like you always get another shot to basically buy Bitcoin at lower levels at some point in time.
And more people will probably be interested, Joseph, in getting a loan at lower prices of Bitcoin, I imagine, than I imagine there's like a whole new cohort of people who are like looking at Bitcoin price now and go, okay, this is where I'd be more interested if I see higher upside.
You would think so. I mean, again, I think we've done plenty of loans at like, we did a bunch of loans at 100, we did a bunch of loans at 50, and we've done a bunch at 20, right? And 15, right? So I think it's more of like when people need capital, they just know whether it's the right situation, because, to be able to say, yeah, like naturally, right, I'd love to borrow money when Bitcoin is lower. Yeah, but then you'd have to know what the prediction is like when Bitcoin is lower, right? So it's
and not have that fear of like
it going even lower. Yeah,
exactly.
You don't control that, right? So basically, so like naturally, like it's like you borrow money when you need it, right? If you don't need it, don't borrow it, right? Now, for the people that want to basically put on more exposure, I think historically the biggest issue has been is that which happens right in all markets, right, as things are rallying, people pair on leverage. They put it on, they put on more leverage. They're like, all right, like this is going in the trend, and then a little pullback is when you get blown up, right? So like most crypto loan books do well when basically prices are increasing, not when prices are decreasing, right? People start to get blown out of their positions, and then they don't put them back on, and then you get that like capitulation event, and then you get this consolidation that needs to happen over some period of time, especially in an absence of a catalyst, right? People think that like when Bitcoin got to like 20K and we got down to 15, no, like 15 was that level where people were like, okay, this is really silly, but we stayed around 20 for a good while, right? So to me, like that was the point when like a lot of people had given up. We're like, we don't want to be there. And today it doesn't feel like anybody's given up yet. So to me, that's why I feel like we could potentially drift lower just because sentiment hasn't gotten that bad yet, right? Like no one's abandoned Bitcoin now, right? Everybody that I speak to is like, no, these are levels that like I want to keep putting on more Bitcoin. So it's really hard to have a capitulation event when people still want to get long.
Yeah, I mean the timeline I have, sentiment looked really bad, and you look at like the fear and greed index and the crypto.
It got to a 6. I saw the other day.
Yeah, and like,
Oh.
look, maybe it's a different cohort. Kind of what I was saying on X. Maybe it's a different cohort, but like the sentiment on X was pretty awful. And so yeah, I mean, I could.
I would argue the previous 2 sell-offs, we didn't really have this like true sentiment. Like X wasn't really a thing in 2017 and in 21. It wasn't as I would say as widely followed as a source of information as it is today, right? A lot of things were happening back then, and I think that like today it feels like Bitcoin and all of crypto and alts are competing against prediction markets, right? We're competing against money going into gold. We're competing against money going into AI companies, right? So like we as an ecosystem, like we're no longer just competing against Bitcoin versus ETH, right? Or something else. It's everything else that's out there. And there's a lot of new shiny objects. And to me, that's probably the biggest concern that I have is that like, how do you make something exciting again? How do you get net new people coming into the ecosystem? And it feels like there's a lot of things that are competing for attention. In fact, so much so that even, our crypto, exchanges, which are the leaders for new adoption, are pivoting into other markets because they see that's where the fast money is being made, even though you're finding that like I guess with a report saying like 90% of the people are net losers. So if you lose money, you're out. You're never playing the game again. And if you make money, then you bet again until eventually you lose all your money and then you're out. So then the question is like, okay, if everyone's broke and everyone has no more money, then how do you people to come back in? So I think that like that education phase is where it's like I'm trying to figure out like where's that net new consumer where 6 months ago we were talking about it, saying that like the ETFs were that onboarding for this net new consumer that was coming into the Bitcoin ecosystem. And then now saying, okay, well, if it's not going to come from the self-custody, maybe the Bitcoin from like the financial advisors, which is really hard for them now to basically go back to their customers and tell them, hey, remember this really shiny Bitcoin ETF?
We missed it.
You're down 40%, right? in 6 months. So that's probably that part of like why it takes a little bit of time for us to like find this and get that footing again. And I don't know what it's going to take, but it feels like we need some of those other things to like run their course. And then for people to come back to being like, this is why we should own Bitcoin, right?
Yeah, I mean, the Zoomer, like the younger people I know, they're looking at, some of them have very good jobs, right? And would have been, comfortable middle-class life 10 years ago, but not the case today. They're looking at, I can, bet on some sports game or, what word is going to be said at a, and make a 4X, 5X, 7X, 8X.
I've got a swing with toss, right? It's literally, it's, black or red. So like, I kind of like those odds. Those odds are a little bit better than having to pick what altcoin is going to be successful.
Yeah,
right?
true.
Yeah, exactly. So I think like number one, we have that kind of issue. But then number two, you have the issue that like young people don't have all that much money. They might gamble, $20 or something.
That's why they're gambling, right? Because I think that like, a lot of the information that they're consuming is showing so many people are successful. And the reality is like it's a very, very, very tiny percentage of people that are successful and participating. I think the difference with at least with alts and other things like that is that you were seeing someone that could put $500 and then be in a situation where like that $500 turned into like $50,000.
Yeah,
those were cases. And then when those became fewer and less people winning, then that's when it became an issue. And I think that the meme coin stuff, I think that did tremendous harm to the broader ecosystem because it took so many people to it removed the scarcity aspect. It made everyone basically an ability to basically generate a token. And then basically so many people came in with lots of excitement and then turned into net losers really, really quickly. And that's a little bit of the concern with like the prediction markets, is that like, how long is that window? And
Yeah.
Right.
hopefully that window is really short, so then people can gap back to Bitcoin, right?
Yeah.
Well, to ask
Well-
Robert, have you gotten into that, by the way? Have you ever given your take like on prediction markets just in general of how long you think that could last? If it's at the beginning stages or if this is a bubble like we've seen before with other little, hype things that come up?
Yeah, I mean, I kind of decided, this is what everyone's talking about. I need to at least like participate in it to understand how it works and that sort of thing. So I've been using Kalshi for the past, I don't know, month or two. I don't know, man. It's pretty like the dope, my need for a rush, my need for kind of a dopamine hit or adrenaline or whatever it may be is a very small 0-day Robinhood account where I just trade 0-day options, and it's like small size, and if I blow it, it's no big deal. It's 1% of my net worth or whatever.
Right.
That's kind of how I've always gotten that adrenaline or that excitement. But I gotta admit that like when you hit a 4x or 6x or 8x in an afternoon on some bet on Kalshi, you're not, I mean, I guess some of them you're watching, that could go against you and stuff. But like generally you just tap a button, and then, the thing happens, you 6x your money, 7x, 8x, 10x. I mean, some of the odds, like it's just, the returns there are just incredible. Like I'm not like, getting super serious and into trying to make a living on Kalshi or anything, but yeah, no, I can definitely see kind of where the enthusiasm comes from. The problem is that, over time, the odds are just like day trading, right? When I got into day trading, I was like, I need to know what I'm about to get into. So I went on Google Scholar and specifically looked up, papers that were written about outcomes, and the distribution of outcomes. And it was like overwhelmingly negative. Like there was one paper that found 99% of day traders over long periods of time were unsuccessful.
Enough, right? You're gonna regress to like what the mean is, right? And like you're
same thing with
time, right?
and same thing with Kalshi, I think, and Polymarket and that sort of thing. I think that over time, and meme coins too, I think that also you had damage done politically as well with kind of the fact that Bitcoin kind of got tied to a particular person, to a particular political party, and then the kind of the meme coins that those Melania and Trump coins and stuff. So there's also damage there. But yeah, I think I don't think that it's like a super durable trend here. I think that there will always be a desire to find entertainment, and I think that for young people betting on certain things, even if it's 10, 20, 30 bucks, that can serve as some form of entertainment for them. So I don't think it ever goes to zero, but I do think that like there will come a point where you get burned over a long period of time. The odds are not good, and you will get burned to the point that you're like, I'm not as into this.
Familiar the things that people are betting on, it feels like there will be more people that get pulled into prediction markets than, for example, alts, right?
Probably, yeah, probably for sure, yeah.
Because it's very easy, like you're betting on things that like you feel like you confidently can guess, right? It's this or that. Well, I think that I know that this is going to happen more than likely, and whereas the onboarding for someone to come in and basically buy Solana or buy things like that, right? Back in the day, even like the ICO wave,
yeah,
tremendous amount of user friction, right? For that.
Yeah.
So today, like, you're consuming prediction markets on Robinhood, right? Like, what percentage of millennials, right, and Gen Zs and everyone else have Robinhood? A lot.
Or Coinbase, yeah.
Right. Like now it's become such a big thing for them. Where like if you log into these apps from a UI perspective, like you have that's front and center. It's no longer.
It's right there.
These are your odds to bet on whatever, right? This game or that game. So it's going to be very interesting to see how that plays out. But like, we're Bitcoin's competing for attention, right? And like any ecosystem, you need users, right? So if you look at like broader ecosystems, right, and social networks, right, the ones that basically got passed away were the ones that couldn't continue to sustain growth and bring in new users. So, I know we're always looking at like, how active the network is and everything else, but it's sort of like, how many new users are we onboarding and bringing in, right, into the broader ecosystem. And ETFs sort of mask that, but it definitely is that aspect where that's kind of like where I'm formulating my thought, that I think it's going to take some time for these things to sort of like weed out, because of that part, that everything that happened last year was this function of like Bitcoin should have been at 500,000. And when it wasn't, then everyone's like, are we sure the thesis is right? And it's like, yeah, like we're all medium to long run very confident, right? The thing is that like what happens prior to that, where like how do we navigate the short term and that catalyst of like trying to find what that looks like? And
I think Bitcoin is going to emerge as like the turtle, over a long period of time. It hopefully, this is my bet at least, it'll kind of emerge as, look, it's not super flashy, right? It is not the hot new thing that'll 20x your money in an afternoon, but it is there and it is appreciating and is decentralized. It is right, all the properties of Bitcoin that we know. I think that it'll just kind of be there. There's no marketing team for Bitcoin, right? There's no CEO. There's no flashy, Super Bowl ads or
because I went to a tech event earlier this morning, and someone was asking me about Bitcoin, and I was like, and they're like, well, like, why isn't Bitcoin doing so? It's like, you do realize there's no CEO, there's no board, there's no like leadership team around this. Like we are all stakeholders in this ecosystem, and the only way it moves is if we all will it into existence, and that aspect. So it's funny that you say that, because that's exactly kind of the reason why you don't have that, right? Ethereum has Vitalik, and and these other networks have it, which it's a blessing and it's a curse at the same time, but it's also its resilience, right?
Yeah,
good way to put it. It's actually a really good way to put it there. Not thinking about it. That can be I was going to say, it can definitely be negative. You got Vitalik Buterin selling, I forgot how much Ethereum last week, and people were talking about it. By the way, for people who are watching right now, still got a little bit of time here. If you haven't already, please do take a second and repost the space or repost the stream. So use the spaces. Please repost the stream. And by the way, Robert, I put that in the private chat. If you should be tagged as well if you want to reshare it for your community out there as well. And if you guys are interested in getting a Bitcoin mortgage and locking in a home, but not also giving up your Bitcoin at these levels, especially, we put a link down below the stream that'll take you to Milo's page. It's Joseph, he's the CEO. And you guys can find out more about that and getting a loan, getting a long-term loan. And I don't know, you get to live in a home you want and get to keep your Bitcoin. It's not a bad deal. Joseph, I was actually going to turn it over to you as well for a few minutes and get some of your thoughts on some recent, downturn action on the prices and stuff like that. And I just wanted to, speak from your perspective as a founder and CEO, how that was for a Bitcoin mortgage company when people were kind of freaking out over melting price action and things like that. And we were talking about this a little bit offline, but I wanted to get some of it here on the air while we're live as well.
Yeah, look, I think that volatility that we saw over the last few weeks, right, which was really accelerated, I would say last Thursday, right, with sort of that 70K down to 60K, right, like that, in a situation where there's like leverage, and there's a possibility of margin calls, right, like that causes a lot of stress out there. And today we've got essentially two products, right? We've got our crypto mortgage product, and then we've got our loan product, and very, very different pictures, right? And it's fundamentally because of what that margin call element is and liquidation level, right? So if you think about a Bitcoin loan, crypto loan, 25% drawdowns, you're in a margin call, a little bit, another 10%, right? You're in a potential to potentially get liquidated, right? If you don't deposit more collateral. So that book, right? Lots of margin calls, lots of situations, because there were a lot of people that were taking out loans at, 100, 110, 90, right? So like trying to get net long into what was the obvious thing that was going to happen, that was Bitcoin 250, right? And when that didn't happen, now people are sort of in the situation where like they're waiting, time is going by, and then people are caught offsides in the sell off, and then now being in a situation, fortunately, we didn't have any liquidations other than two, which both clients were understanding around that, and we were able to take a very sort of like hands-on approach with our clients, talk to them, give them time, not enforce the 72 hours, right, and calls, give them more time to actually be able to sort of bounce back. And fortunately now Bitcoin's at higher levels, and they get a chance to sort of continue, and we want to keep a client, right? We don't want to liquidate them, right? We don't want to eliminate the loan, right? Like we work really hard to build a relationship. We don't want that to end on that side, right? So that's on the crypto loan side. On the mortgage side, again, the design of the product was that it would allow a 65% drawdown, right? So significantly more by pairing it with the real estate. So we had zero margin calls, right? We've actually never had any margin calls on our mortgage product because of that combination. So I think that emphasizes where like you've got a crypto loan product, lots of potentially volatility, margin calls, drawdowns, Historically, right, a lot of deleveraging that has happened or in that product over the last 10 years. And then you've got a product like the mortgage where we experience none of that. Right now, I don't want to say none of that, other than like, hey, our levels of where we would see some of that would probably be like 25, 30K Bitcoin. So still really far away, right, from those levels. So I would say that like every one of these events of like deleveraging, it gives us an opportunity to think about like how can we do things better, how can we change product construct, how can we think about like client notifications and and understanding that like this is a very difficult period. It's not something we want, it's not something we caused, it's not something a customer wanted or caused, but it's just a function of a product that you're borrowing on the basis of the collateral, and then now the collateral is worth less. And it's something that like we think a lot about because me coming from kind of the private banking sphere where the concept of borrowing against your stock portfolio is really, really common, right? There's, I would say, at least $500 billion of basically margin loans that are supported by lots of people's equity portfolios. And it's really, really common for them to borrow against that. And today they borrow at anywhere from like 5% to 8% interest rates. Yet if you think about like the opportunity set on the crypto loan side, it's like north of, say, probably 50 billion. Yet there isn't that many loans, right, on the retail side, right? It's probably closer to like 4 to 5 billion. So what is it in this product construct that makes it so different to what is very common in the traditional finance sense of borrowing against your stock portfolio? Because they're essentially the same product, right? You have Apple stock, you borrow 70% of the value of Apple stock. If Apple stock goes down, you need to pay it back, or we're going to liquidate your Apple stock, right? The crypto loan functions exactly in the same way. Now, Bitcoin has a little bit more volatility, so you have a little bit more collateral. But naturally, right, I think this is like an education phase where, because there's potentially liquidation and margins and all these events, doesn't mean that they're not necessarily good products if they're used for the right purpose, right? Taking that capital and investing in something that actually makes sense and adds value. I think where it starts to become a big challenge is when you take that and you compound leverage and you parlay it back into the same volatile asset, where now you have basically these cascading liquidations because you've now paired your collateral and you have no ability to basically pay it back. So you've taken something, compounded your exposure, and then now all of a sudden you're doing. And if you look at like the contrast between the traditional markets, right, at a private bank, you're not allowed to take the proceeds and buy more equities with it. That's the number one rule. We don't let you use that and buy more. You can't get more of the same equity exposure. And I think that's the part that is the dramatic difference. And we were thinking a lot about that today in the office, right? And having philosophical conversations around this, basically saying it's like, we have somehow managed to allow customers to take on more exposure to something that is the same exposure that could actually hurt them. And thinking about our crypto mortgage product, like the whole premise of it is like, we've taken a product, allow you to keep your Bitcoin and buy something which is going to provide another type of value to you that otherwise you couldn't achieve. So it's just very interesting to see it from the perspective of a company that has two different types of products with two different use cases, understanding that both of them are necessary in the market, but that we've got a long way to go to be able to educate people on what is the right way of using these products and how to be able to apply the right structure to be able to help customers and not put them in a situation where they're doing certain things that they may not be as aware that can happen, because nobody believes that margin calls can happen until they do.
Yeah, right. No, literally. No, that's very nice. And again, for people who are interested, want to learn more, that link is in the tweet below the stream. And you can give Milo and Joseph a follow. They're both tagged in the title here. Same with Robert. Definitely recommend you guys give everyone up here a follow. Robert does. If you guys enjoyed this discussion, Robert has a ton of this as well on his YouTube and his X. And he comes on our spaces as often as he can, which is amazing. Because these are discussions I don't really see much on Twitter. Well, I guess I see it a lot on Twitter. We're a little bit spoiled. That's all we, I guess, kind of all we do. But you're not going to see it on TV. Like, you certainly are not going to see it on TV.
Or 6 months later.
Yeah, literally, yeah. 6 months later, in retrospect, like, we all should have seen this come in after you're down 85.
It's going to be important, right? Because in the future, everyone's just going to be Cloudbot, right? And like basically doing all this stuff. So like maybe we do.
That's possible.
Do more of this, like, hey, we're actually all humans here.
Yeah. Yeah, Robert, last question before we sign off. So for people who are interested in like the housing discussion, how it fits into the macro discussion, Bitcoin. What are some of the places, like especially on TradingView? You're like famous for TradingView charts and all the comparisons, stuff like that you pay attention to. What are some places, like some go-tos that people can look at either on TradingView or other resources you have if they want to find out more and do some more research on this stuff?
I don't have any like TradingView. I don't generally like share my charts or anything like that. I know TradingView has the capacity for all that kind of stuff. I've never really used it for that. But yeah, for TradingView, like the thing that worked for me and allowed me to get so proficient was just time. Like I just literally would come home from work every day, and I would just spend 4 hours listening to macro podcasts and playing around with TradingView. So I did that for years, and at work too, at the day job. I was actually on TradingView a lot too. So yeah, you just time. You kind of get used to it. And really, it's got a lot of data. Like for being relative, I mean, it's free if you want it to be. I pay for the premium, but like the amount of data and the capabilities that it has for normal people. I'm a nerd, so I just eat it up, because like this is amazing that we have access to all this data. And it's in a usable format with good UI and everything. So I'm very grateful that you don't have to pay $20,000 a year for Bloomberg or something.
For Bloomberg, exactly.
And I'm not sponsored or anything. I just genuinely like TradingView a lot. So
yeah, they're fantastic. And if people who do want to learn more, definitely hit up Robert and see his stuff. He posts a lot of great stuff on all platforms. Definitely his YouTube. If you guys want to get some more in-depth stuff as well, he's got his own members channel too. So there's no shortage of education like Joseph was talking about. You have a huge opportunity here to learn and get ahead. And both of you guys, thanks so much for joining. These discussions here, Wolf, are a lot of fun. I learned a lot. And yeah, man, we'll do it again. And for people who are back home, if you haven't already, please take a second, repost the stream if you enjoyed it. And check out Milo's stuff again in the tweet below. And we'll see you guys all in the next one. Joseph, have a great day, man. Thanks so much for coming on. Robert, appreciate you as well, dude.